Hi, I am Marcus. Since our last video 3 days ago, AMD surged 19%, Palantir reported 85% revenue growth, the Nasdaq hit a new all-time high, oil fell below $100, and the US and Iran moved closer to a deal. This week handed investors everything they were waiting for. Let me break it all down. Let me give you the shape of the past 3 days. May 5th, small caps and tech led a rally, setting new intraday records. May 6th, AMD reported a monster earnings beat. The S&P 500 crossed 7,300 for the first time ever, and oil dropped 7% in a single day on Iran deal hopes. May 7th and 8th, the jobs report crushed expectations and Iran talks continued moving forward. 3 consecutive days of mostly good news. Here is what every piece means. AMD reported after the bell on May 5th. Earnings per share of $1.37, beating the $1.30 expectation. Revenue beat, and then the guidance came out. And that is where things got extraordinary. AMD CEO Lisa Su told CNBC that her massive forecast revision was driven by something specific. The demand surge for chips led by the growth of agentic AI. Not just AI chatbots, agentic AI, autonomous systems that plan and execute tasks without human input. That is the next wave, and AMD is saying its order book reflects it already. AMD's beat lifted the entire semiconductor sector. NVIDIA, which does not report until May 20th, rose 5.5% on AMD's results. Intel gained 4%. The VanEck Semiconductor ETF jumped 5%. SUPERMICRO, the AI server maker, surged 24.5% after its own earnings beat. One company's result moved an entire industry. Palantir reported Monday, and the numbers were historic. Revenue grew 85%, the fastest growth rate since the company went public in 2020. Earnings per share of 33 cents, beating the 28-cent estimate. Net income nearly quadrupled compared to a year ago. U.S. commercial revenue, companies paying Palantir for AI software, grew 133% year over year. Palantir CEO Alex Karp wrote in his shareholder letter, and I am reading his exact words, that their results now demonstrate a level of strength that dwarfs the performance of essentially every software company in history at this scale. Revenue per employee reached $1.5 million annually. That is a productivity number that almost no software company has ever achieved. But here's the twist. Michael Burry, the investor made famous by The Big Short, has issued a sell rating on Palantir citing valuation concerns. Palantir's stock has risen 23-fold since the end of 2022. It is down 18% so far this year. The bull case is the growth. The bear case is the price you're paying for that growth. Both views are rational, and that is why the stock is polarizing analysts. For viewers who are not familiar with Palantir, here is what they actually do. Palantir builds AI software platforms. Their original client base was U.S. military and intelligence agencies, helping analyze battlefield data and track threats. They have since expanded into healthcare and Fortune 500 companies. The reason their growth is exploding is that every large enterprise now wants AI software that can actually run their operations, and Palantir is one of the few companies that has it working at scale. May 5th and 6th produced back-to-back record days. On May 5th, the Russell 2000 and the Nasdaq both set new intraday records. On May 6th, the bigger day, the S&P 500 closed above 7,300 for the very first time in history. The Nasdaq gained over 2%. The Dow jumped 612 points. All 3 major indexes closed at all-time highs on the same day. The most dramatic single-day move of the week was not in stocks. It was in oil. On May 6th, West Texas Intermediate crude fell nearly 7% in a single day, from above $106 to $95. The trigger was an Axios report that the U.S. and Iran were getting close to a deal that would resolve the conflict. Oil has been the biggest inflation threat in this market. A 7% single-day drop is the clearest signal yet that resolution is possible. Let me tell you exactly what is being negotiated. The US presented Iran with a 14-point proposal that includes a moratorium on nuclear enrichment and terms for ending the conflict. Iran's foreign ministry told CNBC directly that Tehran is evaluating the proposal. Trump called the talks very good and said a deal is very possible, but then added it was perhaps a big assumption. Both sides are moving, but nothing is signed. Markets are pricing optimism. The reality is still fluid. We covered in previous videos how the oil inflation rates chain was the biggest headwind for this market. Oil above 100 means sticky inflation, means the Fed cannot cut, means growth stocks face pressure. When oil fell below $100 on Wednesday, that chain began to break. The 10-year Treasury yield dropped 6 basis points on the same day. Lower yields directly benefit growth stocks and AI companies. This is why the Nasdaq surged 2% when oil fell 7%. This morning, Friday, May 8th, the April jobs report landed. The U.S. economy added 115,000 jobs. The market was expecting 62,000, nearly double the forecast. This is not a weak labor market. Private payrolls hit a 15-month high. Healthcare added 37,000 jobs. Transportation added 30,000. Retail added 22,000. But as always, read the details. Average hourly earnings rose only 0.2%, below the 0.3% expected and below the current inflation rate. That means real wages, what people can actually buy, are still being squeezed by inflation. Federal government employment declined again, down 9,000 jobs. The headline number is strong. The wage story is more complicated. Here is how the Fed reads this jobs report. Strong job creation means the economy is not collapsing, so they do not need emergency cuts. But wages growing below inflation means there is no wage price spiral that would force rate hikes. Combined with oil falling toward $95, the Fed now has more breathing room than at any point this year. Markets are still pricing 0 cuts in 2026. But the conditions for a cut in early 2027 are quietly building. Disney reported this week and beat on both revenue and earnings, with streaming and parks both delivering strong results. The stock jumped 8%. Disney Plus became profitable for the second consecutive quarter. This matters beyond Disney investors. It confirms that consumer spending on entertainment is holding up despite higher oil prices and inflation. People are still subscribing, still visiting parks, still spending. Uber beat earnings and rose 6%. DOORDASH gained 10% on strong results. McDonald's reported strong quarterly numbers and UBS reiterated a buy rating. Combined with the Disney's beat, you have a clear picture. The U.S. consumer is still spending on rides, food delivery, fast food, and entertainment. The war in Iran has not broken domestic consumer confidence. This is the underlying strength that is holding the market up. Here is a company that flew under the radar this week despite a massive move. ARM Holdings, the British chip design company that licenses its architecture to Apple, NVIDIA, Qualcomm, and almost every smartphone chip maker on Earth, surged 13.5% during the session, then added another 8% in after-hours trading. That is a combined move of over 20% on an earnings beat. ARM is the invisible infrastructure behind every AI chip. SUPERMICRO, the AI server maker that builds the racks holding NVIDIA chips, surged 24.5% after beating profit estimates, and Rackspace jumped 63% after announcing a partnership with AMD to build an enterprise AI cloud for regulated industries. These are the picks and shovels companies, not the AI models themselves, but the companies that build the physical infrastructure AI runs on. They had a historic week. Coinbase had the most ironic week in tech. They reported strong earnings, beat on revenue, beat on profit. And then hours after the earnings release, the Coinbase website went down. The whole platform. Crypto traders were unable to trade during an hours-long infrastructure outage. The company that just reported a beat could not keep its servers running on the night it needed them most. The stock recovered, but the optics were painful. Not everything went up this week. Whirlpool collapsed 21%, missing earnings and lowering full-year guidance, explicitly blaming the Iran war for declining consumer confidence in big-ticket appliance purchases. Mercado Libre, Latin America's Amazon, fell nearly 12% despite strong revenue growth after missing earnings estimates. Expedia dropped 6%, beating earnings but guiding weakly for the next quarter. The war's impact is showing up unevenly across sectors. I want to spend a moment on Whirlpool specifically because it reveals something important. When consumers feel uncertain about the economy, higher fuel prices, war headlines, inflation, the first thing they stop buying is large appliances. A new washing machine or refrigerator is easy to delay. Whirlpool's management said directly that the Iran war is affecting consumer confidence for big-ticket items. They are a canary in the coal mine for discretionary spending. Tesla had a contradictory week. They recalled 218,000 U.S. vehicles due to a software glitch that can delay the rearview camera by up to 11 seconds when shifting into reverse. The fix is a software update, no service visit needed. At the same time, the NHTSA, the U.S. Road Safety Agency, declared the 2026 Tesla Model Y as the first vehicle to meet their new benchmark for advanced driver assistance systems. The stock rose 2%. Markets focused on the safety win, not the recall. Let me give you the full earnings season picture. 63% of S&P 500 companies have now reported. 84% beat estimates. That is the same exceptional rate we flagged 2 weeks ago, and it has held. Companies are beating by 5% on average versus the historical average of 3%. S&P 500 earnings growth is tracking at 28% year over year. This is not a normal earnings season. This is one of the strongest on record. The Iran situation this morning, May 8th, is complicated. The U.S. military fired on and disabled 2 Iran-flagged oil tankers that were attempting to break the blockade. Iran responded by saying the U.S. and its regional allies have violated the ceasefire. At the same time, Iran is still officially evaluating the U.S. 14-point peace proposal. Both escalation and negotiation are happening simultaneously. This is the definition of a tense peace process. Watch oil as your real-time Iran indicator. When the UAE was struck by missiles, oil spiked to $106. When the Axios report said a deal was close, oil dropped to $95. This morning, with the tanker action, oil is back around the $100 level. Oil is telling you exactly what professional traders think the probability of a deal is. In real time, all day, every day. When oil breaks and holds below $90, a deal is priced as likely. Until then, the uncertainty premium remains. The global picture is just as striking. Japan's Nikkei surged 5.7% to a new all-time record. South Korea's Kospi, which we covered in our last video when SK Hynix hit records, added another 6.45%, reaching 7,384. Multiple major global stock markets hitting all-time records simultaneously is a powerful signal. This is not a US-only story. The AI trade is global. AMD's CEO, Lisa Su, used a term that I want to explain because it is the most important phrase in tech right now: agentic AI. Regular AI answers questions when you ask. Agentic AI plans and executes tasks on its own, booking your travel, managing inventory, running complex analyses, without you needing to prompt each step. Agentic AI requires dramatically more computing power than chatbots. It needs more chips, more memory, more data center capacity. This is why the chip order books are exploding. Every company in the AI ecosystem benefits from agentic AI, but in different ways. AMD and NVIDIA supply the chips. Palantir provides the AI software layer that enterprise clients actually use. Microsoft Azure and Google Cloud provide the infrastructure to run it. ARM Holdings designs the chip architecture that makes it efficient. SUPERMICRO builds the servers. The entire supply chain is expanding simultaneously, which is why every one of these companies beat earnings this week. A story that got buried under the earnings wave, but deserves attention. Bloomberg reported that Microsoft is considering delaying or abandoning its goal of matching all electricity use with renewable energy by 2030. The reason? AI-driven data centers are consuming energy at a scale that was unimaginable when Microsoft set that target. This is the hidden cost of the AI boom. Electricity demand is growing so fast that even the most ambitious corporate green energy commitments cannot keep up. Now, here's the thing that nobody in financial media is connecting this week, and it changes how you should read every single earnings report we just discussed. Look at these 3 CEO quotes from this earnings season. Palantir's Karp said they are unable to keep up with U.S. demand. AMD's Lisa Su said the demand surge is being driven by agentic AI. Alphabet's Pichai said revenue would have been higher if they could meet demand. 3 different companies, 3 different sectors, all saying the same thing. The limit on AI revenue right now is not lack of customers. It is lack of capacity to serve them. This is a supply-constrained boom, not a demand-constrained one. That is a fundamentally different and more durable situation. Here is why supply-constrained matters for your investment decisions. When growth is supply-constrained, when demand exceeds what companies can deliver, every dollar of additional capacity generates revenue immediately. The capex that Meta, Google, and Microsoft are spending is not a gamble on future demand. It is a race to serve demand that already exists today. That changes how you should evaluate the companies spending the most on AI infrastructure. NVIDIA has not reported yet. That comes on May 20th, 12 days away. But everything we saw this week is a preview. AMD surging 19% on AI chip demand. ARM Holdings up 22%. SUPERMICRO up 25%. SK Hynix, NVIDIA's memory supplier, hitting records. Every company connected to NVIDIA is signaling that NVIDIA's own order book is enormous. May 20th will be the most watched earnings call of the year. When NVIDIA reports on May 20th, 5 numbers matter: data center revenue and forward guidance. Blackwell chip, their latest AI accelerator, demand signals. Whether NVIDIA itself uses supply constraint language like AMD and Alphabet did. Margin expansion, which would indicate pricing power. And China revenue, where U.S. export restrictions have limited NVIDIA's ability to sell its most powerful chips. Any update on China will move the stock significantly. Let me give you 3 scenarios and what each means for your portfolio. Scenario A, Iran deal reached, oil drops to the 80s, the Fed gains room to cut early 2027. Growth stocks re-rate sharply higher. AI companies benefit most. Scenario B, prolonged stalemate, oil hovers between $95 and $110. Selective positioning, AI revenue generators plus energy. Scenario C, conflict, re-escalates, oil returns above 115. Defensives, energy, and raising cash is the move. Your action plan right now: watch oil every day this week. Below $90 means a deal is being priced as close to certain. That is your signal that the market's biggest headwind is fading. Watch for any official Iran deal confirmation, which would trigger an immediate market rally. And circle May 20th on your calendar. NVIDIA's earnings will be the single most important data point of this entire AI investment cycle. Step back and look at where we are. The market began 2026. Iran went to war. Oil hit $100. The Fed held rates for the 3rd time. The most divided Fed vote in 30 years happened. And yet, the S&P 500 is now at all-time highs above 7,300. The market absorbed a war, record oil prices, a frozen Fed, and an AI revenue scare, and still made new highs. That is a bull market with genuine underlying strength. This earnings season started with one question after the OpenAI report that triggered the April sell-off. Is AI generating real revenue? After 6 weeks of earnings reports, the answer is definitively yes, at scale, across multiple companies, across multiple sectors. Cloud, chips, software, servers, all confirming the same thing. The AI trade is not hype, it is revenue. Let me leave you with the week in 6 check marks. AMD up 19%. AI chip demand confirmed. Palantir 85% revenue growth. AI software at scale. Nasdaq at all-time highs. The market is not afraid. Oil below 100. The biggest inflation threat is easing. Jobs 115,000 versus 62 expected. The economy is not breaking. Iran deal closer. The biggest geopolitical risk is moving toward resolution. 6 things that needed to go right. All 6 moved in the right direction this week. I am Marcus. Drop a comment below which move surprised you most this week. AMD up 19%, Palantir's 85% revenue growth, oil dropping 7% in a single day, or jobs coming in at nearly double the forecast. Subscribe for daily market breakdowns. NVIDIA reports May 20th. I will see you there.